Welcome to the deep dive. So, you asked about it, and we're here to talk weighted moving averages.
That's right, the WMA. Or, yeah, sometimes called moving average weighted, same thing.
Our aim today is really just to get under the hood,
Yeah.
understand how it works for spotting trends in trading.
Exactly. We're working from a Hindi YouTube video by Trading Chanakya. It covers the basics.
But we want to go a bit deeper than just repeating the video.
Right. We're looking at the why. So our mission, what is the WMA? How does it work? How is it different from, say, an SMA or an EMA?
Simple moving average and exponential moving average, yeah.
Uh-huh. And, what are the pros and cons? Why might you actually choose to use this thing?
Okay, makes sense. So maybe start with the basics, the simple moving average, the SMA.
Good idea. So the SMA, it's kind of the standard starting point.
Like if you pick a 10-period SMA.
Yeah, it just takes the closing prices of the last 10 candles or bars, whatever your period is,
Adds them up.
and divides by 10. That's it. Dead simple.
And crucially, every price in that period counts the same.
Precisely. Equal weighting, which gives it that smooth look on the chart.
But smooth isn't always good.
Well, there's a trade-off. Because it treats old data the same as new data, it can be, well, slow.
Slow to react to sudden price changes.
Exactly. People call it lag. It lags behind the current price action.
Okay, like looking in the rearview mirror, as you said before.
Mm.
Useful, but maybe not for immediate turns.
So that brings us to the weighted moving average, the WMA.
And how does that one try to, well, speed things up?
Okay, so the WMA changes the weighting. It doesn't treat all data points equally.
It puts more focus on the recent prices.
Exactly. The very latest price, the most recent candle, gets the most weight in the calculation.
And the candle before that?
Gets a little less weight. And the one before that, even less, and so on. Down to the oldest price in the period, which has the least impact.
Ah, okay. So the newest information matters most. That feels like it should make it react faster.
That's the whole idea behind it, more responsive. The source video suggests this means you could potentially get earlier signals.
Earlier signals to get in and get out.
Potentially, yes. That's the purported benefit.
The video showed this visually, right? Using the FIRES platform.
Yeah, it was a good comparison. They plotted a WMA that was a black line and an SMA, a red line, using the same period.
Which was 50 periods eventually.
Right. They increased it to 50 later, and that's where the difference really became clear.
So what did you actually see on the chart?
Well, with the longer 50-period setting, you could really see the black WMA line sticking closer to the price. It followed the smaller ups and downs more readily than the smoother red SMA line.
So it reacted quicker to fluctuations.
Definitely. The video pointed out times where the WMA started turning down or up just a bit before the SMA caught on, signaling a potential shift sooner.
Like an early warning system, yeah. Okay, but there's another player here, the EMA, the Exponential Moving Average. How does that fit in? They showed that too, right? A blue line.
They did. So the EMA also gives more weight to recent data, like the WMA. It just calculates that weight using a different formula, an exponential one.
So if you line them all up, SMA, EMA, WMA, how do they compare in terms of speed?
Generally, the video presents it like this. SMA is the slowest, EMA is faster than SMA, and the WMA is potentially the fastest, the most responsive of the three.
Fastest signals for entry and exit, potentially.
That's how it's framed, yeah, giving you the earliest heads up.
Okay, so where would that speed be most useful? The video talked about momentum trading.
Exactly. If your whole game is about jumping on those quick, strong price moves.
Riding the wave.
Yeah, momentum trading. Then getting in and, crucially, getting out quickly is paramount. The WMA's sensitivity could be a real plus there.
And they made a specific point about options trading. Because things can change so fast there.
Yes, absolutely. Because with options, even small delays or reversals can, wipe out profits super quickly due to time decay and leverage.
Did they give an example?
They did. There was a point on the chart around 42690 where the WMA apparently gave an exit signal.
Okay.
But the SMA and the EMA didn't signal until maybe closer to 42750.
Wow, that's a 50-point difference in the underlying. That could be huge for an options P&L.
Huge. Getting out earlier, based on the WMA signal in that case, could have saved a lot of profit or prevented a bigger loss.
Okay, that really highlights the potential impact. Now, there was also a subtler point about how the WMA behaves during reversals. That seemed quite interesting.
Yes, that was a key observation. The presenter noted that right when a trend starts to reverse, say a downtrend turning up,
Uh-huh.
you might actually see the EMA slightly above the WMA initially, or below if an uptrend is reversing down.
That seems counterintuitive if the WMA is supposed to be faster.
It does, but the theory presented was that the WMA, because it's weighted so heavily towards the most recent data from the previous trend,
Ah, okay.
it might initially show a slight bias against a brand new reversal, almost like it needs a bit more confirmation.
So it's not jumping the gun on the very first hint of a change. It waits a moment.
That's the interpretation offered. It could act as a kind of filter, maybe stopping you from exiting too early if it's just a minor pullback or some testing.
Interesting.
Then, as the new trend starts to really take hold, the WMA catches up and closes that gap with the EMA, potentially giving a more reliable signal once the reversal looks more solid.
So faster overall, but maybe with a slight built-in hesitation right at the turning point. That's quite nuanced.
It is, and it leads into how the presenter actually uses it personally. They combine it with the RSI.
Relative Strength Index.
Right, yeah, a common momentum indicator. And you know how trading platforms often let you apply moving averages to indicators, not just price?
Yes, smooth out the indicator line itself.
Exactly. So the presenter used to use an SMA on their RSI.
But they found it was too slow.
Yeah, they felt the SMA signals on the RSI came too late, which meant potentially needing wider stop losses if a trade went against them.
And they didn't like large stop losses.
No, explicitly said they preferred multiple small stop outs over fewer big ones. Risk management preference.
So they tried swapping the SMA on the RSI for WMA.
They did. And they found that switch made the signals on the RSI appear earlier.
Ah, so the WMA's sensitivity helped them get that quicker read on the RSI's momentum shifts.
Precisely, which allowed them to set tighter stop losses, fitting their preferred risk style better.
So it's not just about applying it to price, but potentially to other tools as well.
Yeah.
Did they mention anything else about its behavior, like with minor price swings?
Yeah, just briefly. The observation was that the WMA tends to sort of smooth over some of the really small, insignificant price wiggles.
So it doesn't necessarily signal on every tiny fluctuation.
Maybe not. Which could help avoid getting whipsawed, shaken out of a good position by market noise.
So quick on the big moves, maybe less reactive to the tiny jitters.
Okay.
But then came the big caveat, right? About indicators in general.
Absolutely crucial point. The presenter stressed that no indicator is magic. None are inherently good or bad.
It's all about how you use it.
Exactly. Does it fit your strategy? Are you comfortable with its signals, its potential flaws? What works great for one trader might be terrible for another.
Personal preference and fit are key. Okay, so let's quickly sum up the WMA's advantages as laid out in the video.
Sure. Main things were faster reaction compared to SMA, often faster than EMA too.
Leading to potentially earlier entry and exit signals.
Right, which is good for momentum plays, options trading, managing risk closely.
Plus that potential filtering effect during reversals and maybe smoothing minor swings.
Yep, those were the highlights presented.
And the potential drawback, though not explicitly stated as a drawback by the presenter, would be.
Well, that same speed. Faster signals can sometimes mean more signals, and some of those might be false alarms, especially when the market isn't trending strongly.
Right, getting whipsawed is still a risk if you rely on it blindly. Needs context.
Always needs context. Maybe use it with other confirmation tools.
Okay, so wrapping up this deep dive. The core idea of the weighted moving average is that weighting, prioritizing the recent data.
Which makes it generally more responsive than the SMA, and often quicker than the EMA. Its potential lies in giving you those faster reads on price action.
Potentially leading to more timely entries, exits, especially for faster strategies or tight risk control.
But, as we keep saying, it's not a one-size-fits-all solution.
Definitely not. The choice of moving average or any indicator really depends on your style, your risk tolerance, what you're trying to achieve in your analysis.
Which brings us to our final thought for you to consider. Beyond just trading, how might understanding these different weighting methods, like how the WMA values recent data so much more than the SMA, change how you look at market trends?
Yeah, how does knowing the calculation difference affect your interpretation of the lines on a chart, even if you're just observing?
Think about how these different mathematical lenses can offer unique perspectives on the very same price movements, and what underlying market dynamics those subtle differences might reveal.